But if the silver price held steady at $75 for a year, by definition, I wouldn't make any more money than silver because it traded sideways. Gap between the bid and the ask that you see in the physical silver markets. The actual physical silver that I had in vaults and elsewhere, I still have. I'm going to trade certificated precious metals. I understand that some people say metal that you don't have in your hand, you don't own. It's part of the system. That's a risk I'll take because the gap between the bid and the ask in physical markets can be as much as 7%. I think that you had a gold market coming into 2024 that was literally a coiled spring. I'm not suggesting to you, Anthony, the gold price rises 26-fold from here. It's already done very, very, very well. That gold will maintain its purchasing power over the next 10 years, while the US dollar will lose 75% of its purchasing power. The industry is underinvesting in sustaining capital to the tune of between $1 billion and $2 a day. Many pundits point out the fact that 20% of the world's oil flows through the Persian Gulf. What they neglect to mention is between 40 and 50% of the world's export oil flows through the Straits of Hormuz.
And if we go to silver, that was a massive increase over a very short period of time. Would you say that was more driven by mass speculation of the retail investors, or how would you look at that?
Yeah, I would. And again, when we had that parabolic move in silver earlier this year, I decided to take advantage of it. Silver, physical silver in my portfolio, inhabited the speculative part of my portfolio. My own portfolio is divided into three buckets: savings or insurance, which is part gold, part cash; investments, which is high quality mining and oil and gas stocks, as well as some conventional financial services companies; and speculation. And I had purchased a reasonable amount of physical silver some years ago when silver was very widely hated, betting that silver would become less hated, that as the precious metals market continued and the generalist investor came into the precious metals market, that price leadership would change from gold to silver. And both those things occurred. The consequence of that is, given the reasons that I owned the silver had occurred, and given that the price action in silver exceeded my expectations, I needed to decide for myself whether the allocation to silver I had in my speculative portfolio was warranted or not. And I chose to sell about 80% of my physical silver. And I redeployed about half of that into the silver stocks.
Sometimes the smartest move in a roaring bull market is quietly taking chips off the table. As Rick Rule points out here, silver's explosive run wasn't purely fundamentals. It was a sentiment swing from a hated asset to speculative favorite almost overnight. Historically, when an asset shifts that fast, momentum traders flood in and distort price discovery. That's why his portfolio framework matters. Separating insurance, investment, and speculation forces discipline when emotions run high. Selling 80% may sound extreme, but it's classic risk management after a parabolic move. Next, Rick Rule discusses why silver stocks looked mathematically more attractive than the metal itself.
A simple review of arithmetic told me that if the silver price held steady at $75 for a year, by definition, I wouldn't make any more money than silver because it traded sideways. But the best silver stocks were being priced in the market discounting $45 silver, which is to say the best silver stocks could easily increase in value, if not in price, by 50% over the ensuing 12 months. And paradoxically, if the silver price went up, I expected the silver stocks to keep pace at least with silver. And if the silver price went down, given the fact that the silver stocks were discounting $45 silver, while the price action might be ugly, the change in value wouldn't be precipitous at all. So it seemed to me, for about 50% of the money that I recovered from selling the silver, that redeploying into the silver stocks was a better, arithmetically a better speculative decision for me, which is what I did.
Did you see there was sort of a bit of a disconnect between physical silver and paper silver prices? Is that something that you saw as well?
No, I was looking at the valuation discrepancies between the silver stocks and the silver. The silver that I sold was convenient to sell. The silver that I sold was largely the Sprott Physical Silver Trust.
Markets often reward the asset everyone ignores, not the one everyone chases. As Rick Rule points out here, When silver traded around $75, many mining stocks were still priced as if silver were $45, a massive valuation disconnect hiding in plain sight. That gap creates asymmetric opportunity. If silver rises, miners often outperform. If it falls, the downside may already be priced in. Institutional investors quietly hunt these arithmetic mismatches, while retail crowds chase the headline metal price. It's less about predicting silver and more about exploiting valuation lag across the sector. Next, Rick Rule talks about why liquidity and trading mechanics matter more than most precious metal investors realize.
So I didn't have to face the on-market grind, which is to say the gap between the bid and the ask that you see in the physical silver markets. The actual physical silver that I had in vaults and elsewhere, I still have. Increasingly, to the extent that I trade precious metals, I'm going to trade certificated precious metals. I'm going to trade probably the Sprott products because I know them the best. I understand that some people say metal that you don't have in your hand, you don't own. It's part of the system. That's a risk I'll take because the gap between the bid and the ask in physical markets can be as much as 7%, even for good delivery product, never mind junk silver. But the spread between the bid and the ask on the New York Stock Exchange for the Sprott physical products is often 50 basis points or less. They are much more efficient trading vehicles.
What's the best strategy there? It makes a lot of sense. So we've talked about copper. What about the precious metals? I guess the silver and the gold, because they've been extremely explosive.
My view on those is unchanged since the last time we talked.
The biggest hidden cost in precious metals isn't volatility. It's the spread nobody talks about. As Rick Rule points out here, physical silver can carry bid-ask gaps as high as 7%, while exchange-traded vehicles often trade with spreads under 0.5%. That difference alone can erase months of gains for active traders. It also exposes a quiet contradiction in the "if you don't hold it, you don't own it" narrative dominating gold circles. Liquidity matters, especially when markets turn fast. Professional investors weigh transaction efficiency just as heavily as asset security. Next, Rick Rule unravels why the explosive gold rally of 2024 to 2025 may actually be catching up with years of ignored macro pressure.
I think the incredible move that we saw in 2024, 2025 was rear-looking, not forward-looking, meaning that the same set of circumstance that was present in 2024 when people took notice was present in 2018 before people took notice. And I think that you had a gold market coming into 2024 that was literally a coiled spring. And I think the price action that we saw in 2024, 2025 was releasing tension from that coiled spring. The spring wasn't all about the lousy arithmetic of U.S. on balance sheet and off balance sheet and other countries' balance sheet problems. The spring also had to do with the weaponization of the U.S. dollar, the stealing of $300 billion worth of Russian assets, irrespective of your belief in what Russia did in the Ukraine, and the weaponization by the U.S. government of the SWIFT banking systems and other places. What this did is create real demand for gold from a source, foreign central banks, that had been until 2015 or 2016 net sellers of gold. That was a big turnaround. And I think that the price action that you saw, the price explosion that we saw in gold in 2024 and 2025 was really backward looking. It was really making up for lost ground.
The gold surge everyone celebrated may actually be yesterday's news catching up to reality. As Rick Rule points out here, the explosive move in 2024 to 2025 wasn't purely a new trend. It was a release of pressure building since at least 2018. When central banks watched roughly $300 billion in Russian reserves frozen, the message to the world's treasuries was unmistakable: diversify away from dollar risk. That policy shock quietly flipped global central banks from net gold sellers before 2016 into major buyers afterward. Markets didn't react immediately, but eventually the spring snapped. Next, Rick Rule discusses why the real story isn't gold's past rally, but the long-term erosion of dollar purchasing power.
I don't believe that the increases in precious metals prices going forward will be as dramatic as the ones that we've just enjoyed. But I do believe that unless and until the weaponization of the US dollar is discontinued, and until the United States finds a political solution to deficit spending, and until a political accord is reached that eliminates the danger of $120 trillion in unfunded entitlement promises in the United States, and until we have a real interest yield that is above the rate of deterioration of the US dollar, that the value, the purchasing power of the US dollar declines. I believe specifically, as I have said numerous times, that I expect in the period 2025 to 2035, the purchasing power of the US dollar to decline by 75%. There's historical precedent for that. In the decade 1970 to 1980, the purchasing power of the US dollar declined by 75%. And not coincidentally, in that same decade, the gold price ran 26-fold.
The real story isn't gold rising. It's the dollar slowly losing ground. As Rick Rule points out here, the United States is carrying roughly $120 trillion in long-term entitlement obligations alongside persistent deficit spending that political leaders show little urgency to fix. Historically, when currencies lose about 75% of purchasing power, as happened between 1970 and 1980, hard assets like gold respond dramatically because investors search for stability. The deeper issue isn't speculation, it's confidence in monetary policy and fiscal discipline. Next, Rick Rule discusses why gold's future gains may look very different from the explosive rallies investors just experienced.
I'm not suggesting to you, Anthony, that the gold price rises 26-fold from here. It's already done very, very, very well in the period 2000 to 2026. What I am suggesting to you is that gold will maintain its purchasing power over the next 10 years, while the US dollar will lose 75% of its purchasing power, which is to say that the nominal value of gold, the value of gold priced in US dollars, will increase, perhaps commensurately with the decline in purchasing power of the US dollar. Now, people who have a shorter term time frame, people who are more speculatively inclined than I, might not want to look at a gift horse in the mouth. The market, both the gold market and the equities market, precious metals equities market, in 2025 were the third most generous to me in my career. And in fact, had I been younger and more aggressive, the moves that occurred in 2025 would have made it the best year in my life. I was more of an investor in the space than a speculator. And as a consequence of my caution, I did less well than a younger Rick would have. That notwithstanding, the gains were extraordinary. And some people might book those gains.
Investors chasing the next explosive gold rally may be missing the more important long-term math. As Rick Rule points out here, the real expectation isn't another 26-fold surge, but something quieter and more powerful. Gold simply maintaining purchasing power while the dollar erodes over time. Since 2000, gold has already delivered massive returns, meaning future gains could come more from currency weakness than speculative momentum. For long-term investors, that shifts the strategy from chasing breakouts to protecting wealth against inflation and monetary dilution. Short-term traders may lock in profits, but structural trends rarely reverse quickly. Next, Rick Rule talks about a disciplined strategy he used to remove risk from his mining portfolio.
As you may know, I sold 25% of my junior mining stocks in October of 2025. Not because I didn't think that the sector would do well. I've already explained the arithmetic of the next 10 years from my viewpoint, but merely because by selling 25% of my junior holdings, I was able to recoup all of the capital that I had invested in the sector in the period 2018 to 2025, which is to say, by selling 25% of my upside, I eliminated my downside, and by the way, also paid the capital gains tax. Whether or not this technique is suitable for other people is something that is up to them. But I believe that portfolio decisions are personal, and that was mine.
Yeah, okay. It does make a lot of sense. And and I'm guessing those sort of miners have done quite well at the start of the year as well as precious metals continue to go up.
Yeah, I mean, ironically, the junior portfolio that I sold a quarter of is back almost to my original levels, which is to say those stocks that I sold have gone up substantially. That doesn't trouble me a bit. Uh, I had rather large investments in the sector, and I still have very large investments in the sector, but I have no net risk in the sector. That to me is an extraordinary trade. It's worthwhile noting that some of the money that I took off the table selling the junior mining stocks went back into the seniors, which I perceived as having less upside but less downside. And some of it went into physical gold, which has done reasonably well. Um, but those weren't really tactical allocations. I was just allocating risk to reward based on the arithmetic I see in markets over the next 10 years.
One of the most overlooked investing skills is knowing when to remove risk without abandoning opportunity. As Rick Rule points out here, selling 25% of his junior mining stocks allowed him to recover every dollar originally invested between 2018 and 2025, while still keeping the majority of the upside. That strategy, often called free carrying a position, is rarely discussed in retail investing circles, but widely practiced by experienced portfolio managers. Even when those sold shares later rise, the psychological and financial benefit is enormous, because the remaining position carries no net capital risk. Next, Rick Rule discusses how geopolitical tensions are suddenly accelerating gains in energy markets.
The most recent volatility we've seen in the Middle East and I guess the impact that's had on energy. So how are you currently sort of tracking, and let's be honest, this interview is going to go up tomorrow, so probably things may have completely changed by then. But how are you tracking this and how do you actually analyze the impact this is having on energy markets and your investment?
The oil stocks have given me 3 years of performance in 6 months, which is a bit disconcerting. I have not yet begun to reduce my positions in the oil stocks, but people who are traders need very much to consider doing this. Exxon was easy to love at 95. It's much less easy to love at 180 or 185. People need to understand that, particularly the gamier oil stocks. People need to pay attention to their own portfolios. I bought the oil stocks because of deferred sustaining capital investments. The industry is underinvesting in sustaining capital to the tune of between $1 billion and $2 a day. That figure likely has gone up very recently as a consequence of deferred sustaining capital investments in the Middle East, which would be dangerous to make right now.
Oil markets often move slowly, until suddenly they don't. As Rick Rule points out here, some energy stocks have delivered what normally takes 3 years of gains in just 6 months, pushing companies like Exxon from roughly $95 levels to around $180 territory. Rapid price acceleration like that usually signals a supply shock or geopolitical risk premium entering the market. Yet the deeper issue is structural. Global energy companies have underinvested in sustaining production by as much as 1 to 2 billion per day, creating a future supply gap. When investment disappears, shortages follow years later. Next, Rick Rule unravels why Middle East supply routes could become the biggest hidden risk for global energy markets.
These deferred sustaining capital investments impact the industry's ability to produce 2 years from now, 3 years from now, 4 years from now, and the production is difficult to bring back online, which means that in 2029, 2030, it's likely that we, as a consequence of unbalanced supply versus demand, ration by price, and the prices go up. That circumstance, I believe, would lead markets to go up in 2027, 2028. Instead, the markets went up in 2026. If there is a reasonably timely, peaceful or semi-peaceful resolution in the Gulf, then the oil quotes come down and the oil stocks come crashing down. They will go back up, make no mistake, towards the end of this decade. But people need to decide whether they want to lock in sure gains now or whether they want to play the game over the next 2 to 3 years. It's worthy to note, too, Anthony, that it isn't just oil that we're talking about. Oil is particularly important. Many pundits point out the fact that 20% of the world's oil flows through the Persian Gulf. What they neglect to mention is between 40 and 50% of the world's export oil flows through the Straits of Hormuz.
Energy markets rarely move on schedule, and sometimes the future gets priced years earlier than expected. As Rick Rule points out here, years of underinvestment in oil production mean the real supply crunch may arrive around 2029 or 2030, yet markets already began reacting in 2026. That's classic commodity behavior. Traders anticipate shortages long before they physically appear. But geopolitics complicates the picture because nearly half of the world's export oil moves through the Strait of Hormuz, making the region a structural choke point. Investors must decide whether current gains are temporary war premiums or the start of a longer energy cycle. Next, Rick Rule discusses how Gulf supply routes affect far more than just oil markets.
For takers in the eastern part of the Pacific Rim, particularly Korea, Japan, and China, this is a particularly critical source of crude oil. But the difficulty extends beyond oil. The biggest supplier of liquefied natural gas to the world is Qatar, and that is shut in. The world's largest supplier of liquid nitrogen and probably export nitrogenous fertilizers is also in the Gulf. 30% of the world's supply of helium is in the Gulf. About 25% of the world's capacity for refining aluminum is in the Gulf. Perhaps 50% of the world's export supplies of sulfur and sulfuric acid are in the Gulf. So the circumstance that we talk about is important in the oil business, but it isn't limited to oil. And investors and speculators across a wide variety of industries need to pay attention to this. The potential impact, if the war goes on in industries as diverse as petroleum refining and shipping, could be dramatic. I'm not suggesting that the war will go on. I'm not a geopolitical analyst. I'm not a military analyst. I'm really a credit analyst.
When headlines say oil shock, they're only describing a fraction of the real economic risk. As Rick Rule points out here, the Persian Gulf isn't just an oil corridor. It's a critical hub for global industrial supply chains, from liquefied natural gas in Qatar to fertilizers, helium, and aluminum refining capacity. Roughly 30% of the world's helium and a quarter of aluminum refining sit in the region, meaning a disruption would ripple across industries far beyond energy. That's why investors watching shipping, agriculture, and manufacturing should pay attention, not just oil traders. Next, Rick Rule unravels how an extended disruption could trigger the largest supply shock modern energy markets have seen.
Yeah, super interesting. And I was listening to a interview earlier, and they were talking about how it would be the worst shock if this continues, oil shock basically in history if this continues, because currently, as you said, 20 million barrels flow through the Strait of Hormuz, but that actually already there's been 4 million barrels of production that has been stopped because the inventories in a lot of those Gulf countries is sort of getting full, and they want to slow down the production, because if you stop it completely, it then takes sort of weeks and months to actually come back online. So if the current conflict were to continue for a couple of weeks, that would basically bring the off production of at least 12 million barrels a day. That then would take quite a while to come online if this was resolved. So it does seem to be quite a unique situation.
I think that's the case. The Saudis are perhaps in the best shape of anybody to weather the storm, given the fact that they do have a pipeline that goes from their east coast to the west coast at Yanbu. And they do have the ability to reroute as much as 4 million barrels a day that currently goes through the Straits of Hormuz into the Red Sea. For other producers, Iran, Iraq, at least that portion of Iraqi oil that doesn't go north through Kurdistan into Turkey, and particularly Kuwait, this is an ugly circumstance.
Sometimes the biggest risk in energy markets isn't demand, it's how quickly supply can disappear. As Rick Rule points out here, roughly 20 million barrels of oil pass through the Strait of Hormuz daily, meaning even partial disruptions can remove massive volumes from global supply overnight. If production stops entirely, restarting wells and infrastructure can take weeks or even months, creating a shock that markets cannot quickly absorb. Saudi Arabia's ability to reroute about 4 million barrels offers some cushion, but many regional producers lack similar flexibility. For investors, that uncertainty can drive extreme volatility in energy stocks.